We've got stocks ramping up. The Russell 2000 has lost a little bit of steam, but small caps continue to be closely watched in an economy that looks ready to bounce. Joining us to talk small and mid-cap companies here and abroad, David Nadel is a senior portfolio manager of global equities at Invesco. David, thanks for joining us this morning. We've got a lot to talk about here. You've got some very interesting stock picks that you're watching. I think hardly anyone will recognize if they focus on the U.S. So walk me through why right now it seems like you're looking abroad for these plays.
Yeah, that's right. I mean, I think the asset class in general, maybe before we get to the picks themselves, is very overlooked. International SMID-CAP is about 1% of equity allocations by U.S. asset allocators versus about 13% for the Russell 2500 stocks, which is U.S. SMID. Yet the returns over longer periods of time, and especially the risk-adjusted returns of international SMID, are vastly superior to U.S. SMID. So that allocation is, in our view, way too low. I think the whole area is overlooked. You're exactly right. People generally will not have heard of these individual names, but anyone can relate to superior Sharpe ratios, risk-adjusted returns. We have come through a period, in the last 5 years where U.S. SMID has roughly doubled. It's up about 95%. It was up 25% last year. International SMID has been up about 60% for that 5-year period and only about 13% last year. So half the return of a U.S. SMID, which puts us at an interesting inflection point, right? We have internal rates of return for the international SMID companies that are 50% higher than U.S. SMID. So things like returns on invested capital, returns on equity. So this is objectively a higher quality asset class, yet the valuations are about 40% lower for international SMID over domestic SMID. So that's an interesting inflection point. And I guess I see, as an international manager, I see more problems in the U.S. than the markets seem to be willing to recognize. I mean, things like a labor force participation rate, which ranks 40th in the world at 61%. I mean, we have, I think, a major structural problem there, huge amounts of debt on the corporate governmental level, both federal and local. And we see healthier environments, certainly in terms of labor force participation, less political division, et cetera, in these international markets. So we think they're much more constructive.
So I think what's interesting here, David, is the fundamental approach that you're using to evaluate these companies with kind of classical, valuation models, growth models, risk. Right now, it seems that markets are more commandeered by flow, where the flow is finding its way into U.S. stocks. And the question then it gets a little bit more, I guess, kind of difficult, which is more kind of a read on what other traders and investors are going to do, the read of the room. But how does that change in favor of the international? How do those flows make their way over? What's the narrative that's going to have to change to stop that just spigot of money that's been finding its way into U.S. stocks?
Well, I think I don't really have a short, pithy answer for you in terms of what's going to finally turn that tide. But, in general, international equities outperform U.S. equities about 40% of the time. We've gone through a decade-long period where U.S. has led a lot. And as you said in the opening comments of the segment, mega cap U.S. tech has really led. Arguably, that's in bubble territory. I'm not going to make a judgment there one way or the other. That's not what I focus on. But I do know that, almost half the time international beats U.S. The U.S. has led for the last decade. Almost never does a single country lead for 2 decades in a row. So I think we are just overdue. And you don't often get those sort of anomalies in the marketplace where you have higher quality at a lower price for international. So we'll see how it pans out, but we're pretty confident about the longer term.
So right now, the Fed is obviously at play still. Stimulus is at play. The vaccines are being distributed here in the U.S. as well, obviously at a rate that everybody hopes will pick up, but still is pretty good right now, over a million per day going out. How does that affect the dynamics if investors see the U.S. economy as the one kind of set to pounce back and on the most once we see this COVID kind of clearance for us to go back out again? Are we seeing as much vaccine progress in the developing world and some of the emerging economies? Because I would imagine that could be a problem if we're looking at, again, this kind of relative decision that investors have to make.
Yeah, I think, look, we're going to get robust GDP on this recovery around the world. Growth in China is certainly going to trump growth in the U.S. by a wide margin. On the COVID front, we in the U.S. spend twice the OECD average per capita on healthcare, yet we have a fifth of the global deaths in COVID against 4% of the global population. I don't think we're doing terribly well with this. We see better COVID environment almost everywhere else we invest outside the U.S. So I'm not particularly worried about COVID. I do think growth, GDP growth, is going to be robust for the next year, just given a huge drawdown in the past year. But in the U.S., of all the jobs lost, about 10 million of those are considered permanent. That's a pretty significant headwind. You have things like, again, the Russell 2500, 25% higher than it was a year ago. And yet, things like global trade or industrial production are basically right level with where they were before the global drawdown in March. So the markets clearly are way ahead of where the fundamentals are in the U.S. And that's something we don't see in the international markets. That makes us more bullish that the international markets are more spring-loaded. I did see some footage rolling through the screen while I was talking about Daifuku. That's one of our top picks. Happy to explain that one if you want.
Yeah, walk me through it. That's where I was going to go next. Japanese materials company and sort of an industrial play, right, on the manufacturing side?
Exactly. So Daifuku is the global #1 pure play systems integrator for materials handling and logistics. You saw in the video things, bags going through airports, but you also saw all kinds of industrial production. So they are kind of an agnostic play on these mega trends like e-commerce, where you need warehousing and logistics, and automation, where all around the world, companies that produce things or manufacturers are looking for ways to save labor. So Daifuku is a kind of an agnostic play on that. About a third of their revenue comes from services. So we look for business models that have really predictable recurring revenue. That allows us to sort of set and forget, buy and hold type of approach. So we're not trying to read the tape or read the flows, as you referred to before. We're really more long-term buy and hold type of investors. And Daifuku has been a top 10 position for quite a while in our portfolio.
One of the picks here that I think is also pretty interesting to get into is Carl Zeiss Meditech, a German medical devices company. And one of the themes that seems has gone a little bit overlooked over the last year is just how COVID has really monopolized the use of hospitals and a lot of these procedures that haven't gotten done. To me, that seems like a really interesting investment thesis for a post-COVID world. Is this a company that could benefit from some of those procedures that have been backed up finally getting done?
Exactly. You hit the nail on the head. That is really what this is all about. To give you a little bit of background, this is a business like many of ours that has a long history. The Zeiss family started in Eastern Germany in the 1840s. There is a Zeiss lens in every Sony camera. And about 20 years ago, they spun off their medical division, which thanks very much for this video here, which is great. People get a sense of about 50% of U.S. ophthalmic surgeons, so eye surgeons, are using a Zeiss machinery. I mean, they have dominant market share for things, and it's a play on things like glaucoma, cataracts, all these kind of long-term aging diseases or diseases of aging people, disorders, et cetera. And again, dominant market share, really well-run company. But exactly to your point, This is a cataract operation, glaucoma. These are things that can be put off 3 months, 6 months, 9 months. And that's what's happened with COVID, is that space in hospitals has been taken up by those procedures. And you're seeing now the shares starting to really do well. If you look at that chart, thanks for putting that up, you can see they kind of traded sideways for a good period of time as people lost interest in something that was not an immediate play on COVID. In fact, COVID presented a challenge. But you can see how the shares are reacting ahead of results. This is what, I would say has happened in the U.S. markets as well, with the Russell 2500 being so far ahead of fundamentals, and arguably, the NASDAQ and the S&P 500 also quite bubbly at this point. So, yes, Carl Zeiss, number one position, has been for a while. We've really stuck with it through that period of disinterest from the market, and that's typical of how we invest.
Looks like it's breaking out right now. Big jump here to kick off the year. David, love the deep dive into the company picks. Appreciate the macro walkthrough too. Really informative block. Thanks for joining us.
Thank you very much, Oliver. Have a great day. Thank you.
Thanks a lot. David Nadel from Invesco, Senior Portfolio Manager, making the case for global SMID-CAP stocks. Pretty interesting picks. Okay.